Diversification. Don't put all your eggs in one basket. This fundamental principle of investing can make the difference between building lasting wealth and experiencing devastating losses. Today, let's explore how diversification protects your investments and reduces risk. Diversification is a strategy of spreading investments across different asset classes, sectors, and regions to reduce overall portfolio risk. Think of it as not relying on a single investment to determine your financial future. Instead, you create a balanced mix that protects you when one area underperforms. Imagine carrying all your eggs in one basket. If you drop it, every single egg breaks and you lose everything. Now imagine spreading those eggs across multiple baskets. If one basket drops, you still have the eggs in your other baskets safe and intact. That's exactly how diversification works with your investments. There are 4 main types of diversification. First, asset class diversification includes stocks, bonds, real estate, and commodities. Second, sector diversification spreads investments across technology, healthcare, finance, and energy. Third, geographic diversification involves both domestic and international markets. Finally, company size diversification includes large cap, mid cap, and small cap stocks. Each type adds another layer of protection. Diversification matters for 3 critical reasons. It reduces portfolio volatility by balancing losses in one area with gains in another. It protects against market downturns in specific sectors or asset classes. And most importantly, it provides consistent returns over the long term, helping you sleep better at night knowing your investments are protected. Here's a sample diversified portfolio. 60% in stocks for growth potential, 25% in bonds for stability, 10% in real estate for tangible assets and income, and 5% in cash for liquidity and emergency needs. This allocation balances growth with security, though your personal allocation should match your risk tolerance and goals. Avoid these 3 common mistakes. First, over-diversification where too many holdings can actually dilute your returns and make management difficult. Second, investing in correlated assets that move in the same direction, which defeats the purpose of diversification. Third, ignoring rebalancing, as portfolio drift over time reduces your diversification benefits and exposes you to unintended risks. Remember these key points. Diversification is your best defense against market volatility and unexpected downturns. Spread investments across multiple asset classes and sectors to maximize protection. And regular rebalancing maintains optimal diversification, ensuring your portfolio stays aligned with your goals. Start diversifying today and build a more resilient financial future.
If you like this video, hit that like button and don't forget to subscribe. Visit CodeLucky.com for more such useful content.